Doing your own financial due diligence. What you need to know. Hey everyone. Today I'm diving into a topic I haven't practiced myself, at least not fully until recently. But I'm definitely planning to do more of in future deals. Yep, we're talking about doing your own financial due diligence, or FDD. When I started buying businesses, even though I'm qualified to do FDD, I hired accountants to do the heavy lifting for me. Why? Because I wanted to reduce risk and, frankly, I didn't fully trust my own objectivity at the time. But after a few deals, I realized that doing my own financial due diligence could have saved me from some surprises and given me a much deeper understanding of the business before I took it over. So what exactly should you be looking at when you do your own FDD? Don't worry, while it might sound complicated, the seller should be the one providing all the information. Your job is to know the right questions to ask and how to interpret the data they provide. Let's walk through the key things you need to focus on. First up, profit and loss. Sales are the lifeblood of any business, so you want to really dig into the details here. Look at sales by customer. Are they dependent on just one or two clients? That kind of concentration risk could really hurt you if a major client leaves. Next, review sales by product or SKU. Are most of the sales coming from a small handful of products? A quick Pareto analysis can show you if 80% of your sales come from just 20% of your products. That insight helps you understand where the real value lies. Seasonality is another factor. Does the business experience big peaks and valleys throughout the year? That has a huge impact on cash flow planning. Also, ask whether there are any future sales contracts or pending orders that offer some revenue certain. Why going forward? Next is the cost of sales. It's critical to understand how costs are calculated. For example, are production wages included in cost of sales or lumped in with overheads? You need to distinguish between fixed and variable costs to understand how the business will behave when sales go up or down. Review gross profit per product. If profit is tied to just a few items, that's a red flag. Look at where you might cut costs to improve profitability. Compare purchases to cost of sales and inventory levels. Is the stock slow moving? That can tie up cash. Review the key suppliers too. If they're relying heavily on just one supplier, that could be risky. Finally, compare the business's gross margin to competitors to spot pricing or cost-saving opportunities. Then, take a close look at overheads. This is a mixed bag of expenses: rent, advertising, wages, software subscriptions, and more. You want to go through each expense line by line and ask for backup or clarification. For wages, don't just take a lump sum. Ask for payroll data so you know exactly who's being paid and for what roles. Compare these figures year over year to spot any major changes or trends and ask for explanations behind any spikes. Now let's talk about the balance sheet. It also deserves detailed scrutiny. Go through each line item and ask for breakdowns. Start with cash. Review the bank statements and reconcile them with the reported figures. Cash doesn't lie, and it gives you a true picture of liquidity. For stock, get a breakdown by SKU and cross-check with recent sales data to identify slow movers. For aged debtors, are there any customers whose payments are long overdue or potentially uncollectible? That's a direct hit to your cash flow. For aged creditors, too many overdue debts could signal deeper cash flow issues. Watch out for director's loans. Find out if the current owner has taken money out of the business and how that will be handled in the sale. Also look at other debtors and creditors and ask for full details. You don't want hidden liabilities. Check long-term liabilities and any financing arrangements. Understand the repayment terms and make sure there aren't any restrictions on loan transfers. Be on the lookout for debentures or personal guarantees. These can complicate a sale and might require lender approval. Okay, so now you've done your FDD and you've identified some risks. What's next? You have a few options. First, if the risks are too significant and you're not comfortable, walk away. It's better to pass on a deal than to get stuck with a bad one. Second, look for ways to mitigate those risks. For example, if the business is over-relying on one supplier, Start sourcing alternatives before you finalize the deal. Third, ask the seller for warranties. These can offer you legal and financial protection after the sale. You can also renegotiate the purchase price to reflect the risks you've uncovered. Finally, consider using an earn-out structure. This means deferring part of the payment and tying it to the business hitting certain performance targets. It is a great way to make sure you only pay full price if the business performs as expected. Doing your own financial due diligence isn't easy. It takes time, effort, and a bit of financial know-how, but it gives you a real edge and helps you hit the ground running after the deal is done. If you found this helpful, give it a thumbs up, subscribe for more business tips, and let me know in the comments, have you ever done your own FDD? Or are you planning to for your next deal?